Hi, it's Vina Jones-Cox, and so many of you have made comments in the comment sections of my videos about how angry and aggressive I seem on my videos. So this is me smiling. I'm not an angry, aggressive person. Yeah, I get worked up about stuff sometimes, like when people are doing the business in a way that's illegal or immoral, or the government works me up sometimes, but really I'm a very happy person, I swear. See? Today we're going to talk about how to actually calculate the cash flow on single-family rental properties. And this is a thing that I find even experienced investors don't quite grasp, or they misstate it sometimes. And one of the ways in which this came to my attention recently is that I got an email from a student who was telling me about a subject to deal they wanted to do on a rental property. They wanted to take over someone else's mortgage and then rent the property out for long-term wealth. And the numbers they gave me were this: the house will rent for $1,300 a month, and the outgoing payment is $1,028 a month, and therefore they should do this deal, according to them, because the cash flow is $272 a month. The problem with this is that it is completely 100% wrong. The cash flow on this property is not $272 a month. In fact, the cash flow on this property might be negative because there are some things we do not know here. And even with what we do know, there's just no cash flow in this deal. So let's talk about the right way to figure out what cash flow is on a single family home. It is not rent minus principal, interest, taxes, and insurance. This is not cash flow. In fact, part of my issue and what I asked back to the student on this was, does this payment even include taxes and insurance? Because just telling me what the mortgage payment is does not tell me what it consists of. If there are taxes and insurance on top of this monthly payment to the bank, obviously we're in big trouble here. The way that you calculate cash flow on a single-family home is rent minus principal, interest, taxes, and insurance, but that is not all the expenses that go into owning a single-family rental property. Guys, I've been doing this for decades, and trust me, this is not the math. There's another thing that you have to take into account, and that is a general slush fund for vacancy, for maintenance, and for replacement reserves. Now, what does this cover? Your property's not going to be rented all the time, so you're not going to get that rent every single month, right? That's the vacancy. Maintenance: when people live in a property, stuff goes wrong. You have to go replace the door on the cabinet because it mysteriously fell off, or a window breaks in your rental property, or the tenant calls you and says they don't have any heat, and you got to send over a furnace guy to find out that the pilot light has gone out, or that the furnace filter hasn't been changed in 2 years. That is your maintenance. And then this replacement reserve thing is something that accounts for the fact that even the stuff that is not going wrong is still going wrong. Look, I know you just put a roof on that rental property, but a year later, that roof is only got 24 years left. And a year after that, it's only got 23 years left. And it's the same thing with the water heater and the kitchen and the windows and the concrete surfaces, and just about everything that's not the real estate itself is slowly going bad and will eventually have to be replaced. The replacement reserves accounts for the fact that the stuff is going bad and you need to put away money so that when the roof does go bad in another 5 years or 10 years or 25 years or whatever it is, that you have the money, the house has paid for it, right? That you don't suddenly find yourself unable to fix a leaky roof because you didn't put any money away to account for that stuff. Now, the vacancy, maintenance, and replacement reserves on a typical single-family home are around 20% of the gross rents. 20% of gross rents should be put aside for vacancy, maintenance, and replacement reserves. There are about 3 lessons I wish I had been taught a lot earlier in my real estate career, and this is one of them. Keep reserves. Do not spend all of the money that's left over after you pay your regular monthly expenses, right? Starting to do that about 10 years ago completely changed how big a deal it was when the water heater that was only 2 years old and not under warranty anymore suddenly went out. That kind of stuff happens, right? Tenants move unexpectedly. Things happen. Having the money in the bank to deal with them is a huge stress reliever. By the way, it's going to be 20% of the gross rents only if you stabilize the property at the beginning. That's another thing I wish somebody had taught me better when I was first starting out. Many times you'll buy a rental property and the roof is 15 years old, it's got 5 years left in it, so you go, I'll deal with it when it starts leaking. And what you end up doing is spending a little bit of money a lot of different times to keep that roof maintained instead of just biting the bullet, replacing the whole thing. It's easier to borrow money when you buy a property than it is later on anyway. So 20% is a stabilized property. If you have a property with a 10-year-old furnace and a 15-year-old roof, and that's the deal you're making, it's actually going to run more than 20% of gross. 20% of gross is for stabilized property. There might be some other expenses that you need to take into account here. One is if you're going to have the property professionally managed. That is not included in the vacancy, maintenance, and replacement reserves. Property management for a single-family home runs between 7 and 10% of the gross rents. Another thing to look at is owner-paid utilities. Now, you might be thinking, well, in a single-family home, owners don't pay utilities, except sometimes there are some utilities that the owner is just expected to pay. For instance, we've got some cities here around where I live where your property taxes cover garbage pickup if you're an owner-occupant. But if you're a landlord, the same property taxes, in fact, you pay more property taxes as a landlord typically, do not include that trash pickup. You're billed for it separately and quarterly. In some places, the landlords choose to pay the water bill, even in single-family homes, because the downside of the tenant not paying the water bill is so huge, i.e., the landlord gets stuck with a gigantic bill when the tenant moves out, that they just decide to go ahead and include the utilities in the rent. So the correct evaluation is rent minus principal, interest, taxes, insurance, minus 20% for vacancy, maintenance, repair. If you're not self-managing, you got to deduct another 7 to 10% for that, and then any owner-paid utilities. Let's go back to the example I was presented with and see whether this person should do this deal. If we assume that this payment does in fact include taxes and insurance, which was not made clear to me in the question, and by the way, if it doesn't include taxes and insurance, those are among the easiest things to get a grip on, right? The county will tell you what the taxes are. You can call your insurance agent and they'll tell you how much it's going to cost to insure the property. By the way, also, if she's buying this property from an owner-occupant, the owner-occupant's insurance is not going to be the same as her insurance. The insurance is going to go up when it becomes a rental property, and also the taxes may go up, because if this owner paid, let's say, $150,000 for the property, and you're buying it subject to the existing loan, but you're paying $180,000 for it, the county's going to reevaluate it at that $180,000, and your taxes are going to go up. So you better figure that even if this is included in the payment is going to go up after you buy the property. So even if we assume that tax and insurance are included, what we really have is a 1028 payment and another $260 in what? Vacancy, maintenance, and replacement reserves, which leaves us a cash flow of not $272, but $12 a month. And that's assuming, again, no overpaid utilities, and that that you are self-managing, because if you property managing, you're now in negative territory. If you're getting a property manager involved, you are in negative territory. Now, I know a lot of wholesalers watch this channel, so let me say, do not go to a buyer and say, I've got this property for sale, and it will cash flow $1,300 a month. Oh my gosh, I hear that all the time. Wholesalers say, it's a great deal because it's only $50,000 and it'll cash flow $1,300 a month. That's not the cash flow, that's the gross rent. If you're going to bother to state what the payment or what the cash flow is, you really have to do the math, and the part of the math that you can't do for your buyers is the part about what is the principal and interest portion of their payment going to be, because you don't know what kind of financing they're getting. If they're getting conventional financing, it's going to be lower than if they're getting private financing or hard money financing, and if they pay cash for it, obviously there is no principal and interest payment. So just be careful how you talk to your buyers. Say the gross rent's $1,300 a month. After taxes, insurance, vacancy, maintenance, and repair or replacement reserves, it should cash flow about whatever that number is. Maybe in this case it would be $800 a month. Then whatever financing you get, you know how to calculate your actual cash flow. This is pretty basic real estate financial literacy stuff here, but I see so many people making the mistake of getting excited about a rental property because it cash flows $1,300 a month and just not being able to do the math on the expenses. So I hope this helped you out. If there's a video you would like to see get made to answer one of your basic questions, let me know in the comments section below. Also, feel free to leave your comments, share this video with your friends, and do not forget to subscribe, and I will see you next time.